These are 5 trick questions that are asked during accounting job interviews. These are very mean, nasty questions that I've heard other people use during accounting interviews. I've heard from hiring managers and I've heard from people who are looking for jobs that they've heard these questions before. So I wanted to go through these questions and answer them in detail so that if you encounter any of them during a job interview, you can answer them. Welcome to another video, guys. My name is Bill Hanna, and in this channel we discuss tips and tricks that will help guide you in your accounting career. If you're interviewing, we'll give you tips on how to perform well in these interviews, and if you already have a job, we'll provide you here with the knowledge that will help you earn more money. As you've heard before, the more you know, the more you earn in your job. So tune into this channel, and if this is the first time here, please hit the subscribe button and the notification bell so that you don't miss out on any of the videos that I put out weekly. And today we're discussing 5 trick questions that are asked during accounting job interviews. And the reason why I'm qualified to talk about it is because I'm a controller right now, and I sat at both sides of the table, both as the hiring manager and on the other end of the table as the job seeker. So what we'll do is we'll go through the 5 questions and their answers by going through the least tricky question first, and then we'll work our way through the most tricky question toward the end of the video. I'll save that for last, and as well as I'll provide you with some tips on if you are encountering any of these questions during a job interview, how should you behave? How should you react to hearing this kind of questions? And so without further ado, let's jump right in.
You get the job, we're celebrating after, okay?
And if I don't get the job, are we still gonna smoke that pot?
Probably, yes.
So starting from question number 5, which is the least tricky, the question goes, why is net income different from cash flow? And so the interviewer is asking you why, when you look at the income statement, net income doesn't equal cash flow, whether it's inflow if you're making income like net income, or net loss, cash outflow. What's the difference between the two? And the answer to that is that obviously there are certain items that are non-cash basis that go into the business, and that's what makes net income different from cash flow. Now, the only way for your net income and your cash flow to be equal is if you're running your accounting on cash basis. There are 2 ways to run the accounting for a business. If you're a very small business, you're most likely using cash accounting. If you're a bigger business, you're most likely following US GAAP and you're running your business on accrual. So there is cash accounting and accrual accounting. In cash accounting, net income will always equal the cash flow, so that you're recording the transactions only when the cash occurs. So like if cash comes in for revenue, that's when you record revenue, and when cash goes out, that's when you record the expense. And so in that case, cash flow will always equal your net income. However, for businesses as they get bigger and mature, they follow US GAAP. Usually the threshold is $5 million in revenue. Once you go beyond that, you most likely want to follow US GAAP, which is accrual accounting. And in that case, net income is different from cash flow. And the reason why that is because number one, for your sales, when you look at the income statement, the top line is going to be sales revenue. That's going to be most likely credit sales. So you're selling your product or service on credit, and you are issuing an invoice and receiving the cash in the future. And so your revenue is not going to equal cash because the cash comes in the future. Now, the second item here is that accrued expenses is an item that you account for when you're running accrual accounting, and you want to account for expenses even though the cash has not been spent. And so accrued expenses is recording the expense in the period which the transaction or the service has been rendered, even though you haven't received the invoice or spent the cash, but you still record accrued expenses. So they show up in the income statement and affect net income, but there's no cash flow impact from them. And the third item is non-cash items that are recorded on the income statement, such as depreciation and amortization. And we all know that depreciation and amortization have no cash impact. And so depreciation is just to record the cost of a fixed asset over the life. So if you buy a machinery or equipment, it will have a useful life of like 5 years, as an example, and you amortize or depreciate the cost over 5 years. There's no cash impact from it. It's only affecting net income, but not cash. And then you have activities such as loans. Obviously, if you're receiving a loan, there's cash that's coming in that's going to be cash flow. but it's not going to show up in the net income. It may show up in a small way as an interest in the net income or the income statement. However, the bulk of it, which is the loan itself, is going to be much bigger, and that's going to be cash flow. And the fifth item here is CapEx. CapEx is obviously capital expenditure, and that's the company investing in the future and buying fixed assets, machinery, and equipment. And these are things that are going to show up in cash flow, but are not going to be part of net income. And that's going to be also contributing to the difference between net income and cash flow. Now, if you want to get all fancy, you might mention to the hiring manager that the way to tie net income and cash flow together is a statement of cash flow. So if you look at a statement of cash flow, it begins by net income and it reconciles that all the way down to cash. So it begins from net income, and then it factors in non-cash items such as depreciation and amortization, and then operating or cash from operating activity that will take into effect accounts receivable and accounts payable, and then it will take into effect the cash received from financing activities such as loans or interest, and then it will go through the cash flow from investing activities such as capital expenditure or CapEx, and then it will reconcile all that down to cash. And so that's how you give him even a better answer. So the answer to the question is showing the difference between net income and cash flow is by mentioning these factors that contribute to the differences, which is credit sales, accrued expenses, non-cash items, loans, CapEx. And then if you want to get all fancy, you might mention the cash flow statement that ties the two together. And that's the answer to question number 5 in our list. And we'll go now to question number 4. Okay, so the next question on our list goes like this. If DSO is high, how do you fix it? And DSO stands for Days Sales Outstanding. And if you don't know, Days Sales Outstanding is the measure of the number of days it takes to convert sales into cash. And so this is basically the collection cycle. This is how long it takes from the moment you issue an invoice on average to the point you get the cash in the bank. And so the question is, if your DSO is high, how do you fix it? And the first thing you need to think about when you hear this question is to think about the actual equation for DSO. So DSO is accounts receivable balance divided by credit sales. Obviously, we say credit sales here because we're not concerned with cash sales, right? Cash sales are received on a spot. We're only concerned with credit sales times the number of days in the period. And so if we're measuring for a month, you take the AR balance at month end divided by credit sales for the same months time the number of days in the month, whether it's 31 days or 30 days, whatever the case is. And if the number is too high, usually an ideal collection cycle is about 45 days. So if in this case, this number is high and it's 60 or 70 days, here are the things that are contributing and are making this number too high, and it's also how you fix it. So the first factor is slow payers, and this means that you probably have some customers that are slow payers, right? And these are probably contributing to this number of days that it takes to collect the cash. B is bad payment terms, and this means that in the contracts that you are drafting with your customers or on your invoice, the payment terms are not good. So maybe you should make them 30 days if they are today 45 or 60 days. So you should consider making them shorter. And the third item here is that it's hard to pay, meaning you are making it hard for the customer to pay. You should make it super easy and super intuitive for the customer to pay you by listing all the payment methods on the invoice, making sure that your banking information are listed on there. So if you accept credit card, make it simple there to have a link or instructions on how to pay you by credit card. So the easier you make it for them to pay you, the lower the number of DSO will get. And this is the fourth question on our list. Now the third question on our list is, what is the current corporate income tax rate? And maybe you're not necessarily interviewing for a tax position, but still the question is relevant for any accounting position because the hiring manager wants to gauge your general knowledge or ability to know what's going on, and just whether you're aware of what's happening around you. And the corporate income tax rate is something that every accountant should know. And in the US, the rate is 21%. And so you should read up on the country you're in or the region you're in, what is the exact corporate income tax rate, anticipate that question, and so you can be ready for it. And on to the next question. Now the second question on our list goes like this. if working capital is negative, is it a sign of trouble? And now let's refresh our memory on what working capital is. So working capital equals current assets minus current liabilities. And so working capital represents the amount of liquid assets that the company has that can be converted to cash rather quickly minus its current liabilities. And so what goes into current assets will be things such as cash, accounts receivable, and other liquid investments. What goes into current liabilities, that will be things like accounts payable and accrued expenses. And so the difference between the two represents the amount of liquid assets that the company has, which is current assets minus current liabilities. And so to the question whether working capital is negative, whether that's a sign of trouble or not, you got to look at the specific circumstances. So the answer should be it depends. If we're looking at a business that is a cash business, such as a restaurant, you'll find that they collect all of their sales on the front, so that's like cash sales, and they try to delay their payments to the suppliers on the AP side, and so their accounts payable is growing while their accounts receivable is non-existent, and so you'll find that their current assets gets bigger than current liabilities and leads to a negative working capital. And so it depends on the situation. The right answer here should be it depends. A negative working capital isn't necessarily always going to mean a bad or sign of trouble. You have to look at the actual circumstance, examine what goes into current assets and current liabilities, and make a judgment based on that. All right, guys, we're down to the final question here, and this is the most tricky question, and I'll tell you why it is the trickiest question in my opinion. And the question goes, how do you record profit on a sale of a TV if the sale price is $1,000 and the cost is $800? Now, in reality, this question is very straightforward, right? You're only selling a TV for $1,000, that's your revenue, and the cost to you is $800, and this should be very straightforward, and I'll show you how you book that transaction. But the reason why this is tricky is because the hiring manager is stressing on the word profit, and so he's trying to see how you record profit. And the reason why this is tricky is because you're not necessarily recording profit. Profit is not a GL or a journal entry that you book. Profit, I'll show you, profit is actually a line item on the income statement. And so basically the answer should be, hey, the recording for this or the journal entries for this will go something like this. And for sales, you have $1,000 that you're booking. So sales have a credit nature, and so that will be $1,000 on the credit side. And cash, you're debiting cash for $1,000. So that's your first journal entry. Debit to cash, credit to sales. And the second entry you're making is credit to inventory to reduce it by $800, and debit to cost of goods for $800 to record the COGS on this. Now, the way that profit gets populated in the income statement is that revenue from here is $1,000 and COGS is $800, and so profit is $200. What the interviewer is trying to do here is trying to see if you will make a mistake and say, debit $200 to profit, or using profit as a journal entry or anything like that. That will be a sign of trouble for him. So basically, this is a very simple question that the interviewer is trying to frame to you in a more tricky light, so that they will trick you. But this is very easy, and as long as you record the journal entries and show the effect of the income statement, you'll be doing the right thing here. Now, as I mentioned at the beginning of the video, I mentioned that I will tell you how you should behave or react when you feel like the question you're being asked is a trick question. So the first thing you should be doing is that you should be asking the hiring manager to repeat. So don't be afraid to ask him to repeat the question again. If anything, it will show that as a sign of you being insightful. You want to make sure you understand the question before you go ahead and answer it. So don't be afraid to ask him to repeat the question. Second thing is ask for a pen and paper. For me personally, whenever I'm answering any kind of question like that, I need to visualize it. So if I have a pen and paper, I can write it down and I can look at it, and that will give me a level of understanding much better than if I try to answer it based on just hearing the question. Visual is always better. Then the third thing is to slow down. There is no pressure. This is not a race here. There is no pressure for you to try to do this fast. You're not being timed to answer this question. So take your time. This will also show a sign of maturity, a sign of that you take your time and you want to provide the right answer. So my advice here is that you slow down And so this was it, guys. These are the 5 trickiest questions that I've seen being asked in the accounting interviews, and the answers to them, as well as my advice on what to do when you encounter these questions. If you like the content of this video, please give it a thumbs up. And if you haven't already, please subscribe to the channel. And if you know someone who's going to a job interview or preparing for an accounting job interview, share this video with them. This will help them. And thank you for watching, guys. I'll see you in the next video.